Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast site, my own website, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz or at Banking Day. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 13 in our series for 2024, and today's date is Friday, April the 26th. First, I'll be talking to Tim Gaspar, Director at Hatch Financial Services. Tim has worked for 15 years as a mortgage broker, and he knows exactly what's going on in the market. And I'll talk to Indeed economist Callum Pickering about Australia's latest unemployment figures. But first, let's talk to Tim Gaspar.
Well, Tim, what are the big issues for the mortgage broking industry in Australia today?
Well, as a mortgage broker, I guess the thing that's most occupying my time is helping clients and the biggest challenge they're facing is to their borrowing capacity at the moment. There was some research done recently, which I was looking at a little bit earlier today. Since the start of COVID in 2020, the borrowing capacity of most borrowers has reduced by 30 to 35%. So if you're thinking about borrowing $1 million, that's $300,000 less that they can borrow now. And therefore, for someone trying to buy their first home or someone looking to move to their next home, their ability to execute that plan is now greatly reduced because they can't borrow enough.
What's caused that?
It's fundamentally it's the rise in the interest rates over that period of time. So at the start of COVID, the RBA cash rate was around 0.35, and it dropped down to 0.1, and now we're up to 4.35.
And lots of economists are predicting a rate cut this year, but inflation, I think, has gone sideways.
It has, and they were talking about 3 rate cuts this year as we entered Christmas period last year. And now they're talking about maybe a rate cut later this year. In the US, the talk of rate cuts is being pushed further back. So I don't think you can rely on rate cuts to see this change.
In fact, there's a view by some that there won't be a rate cut until next year, until 2025.
Quite possibly.
So where does that leave the mortgage broking industry?
Well, it leaves the market in a position where it's really hard for people to get in or to make their next move. And so we're seeing less transactions than we might otherwise. And the other big thing that we're noticing is that it's really hard for clients to refinance to secure lower rates, because if they set their loan up 2 years ago, maybe on today's rates, they can't afford that same loan in the eyes of the banks.
What about investment lending?
The impact's very similar. Yeah. It's around that 30 to 35% decrease in borrowing power.
So if anyone wants to buy property for commercial use, same
Exactly
thing.
right. Yeah. Now I should note that there have been some things that have been happening to try and offset that drain on borrowing power, in particular in the area of refinancing. So a number of the banks have an alternate refinance policy that says that rather than applying a 3% buffer to current rates to assess affordability, they'll only apply a 1% buffer. And the conditions for using that policy are that basically it's a dollar for dollar refinance, so you're not seeking more money, and you can demonstrate that you're moving onto a lower rate and therefore you're overall better off.
There's also been a surge in what I've noticed as part-time brokers. Have you seen that?
I read some things in the I think the Sydney Morning Herald talking about the number of loans that were being written by brokers who hadn't written, significant volumes. Most of the brokers that I talk to and see are full-time brokers, and those that are part-time appear to be either, maybe parents with young families who are working and balancing family, or accountants or financial planners who do a bit of mortgage broking. It must be really tough to be an expert both as a financial planner and an accountant, as well as keep up with what you need to know as a mortgage broker. So hats off to people if they think they can do it. I think there's enough to know and to keep across as a mortgage broker for that to be a full-time endeavor.
So being a part-time broker and sort of managing a family and managing an accounting business that would be a struggle.
It could well be. I mean, if yeah.
What about the impact of AI?
That's going to play out in lots of different ways. We're seeing it in the way the banks are adopting AI to process documents and information that's coming in terms of analyzing it, categorizing it, and streamlining their processes. And then brokers are starting to get their heads around how they can use AI to improve the way they deliver service, whether that be preparing applications to send to banks, or from a marketing perspective, creating content to share with their customers.
But you can probably predict that some of the larger brokers will buy AI to get most of the apps done.
Yeah, look, AI is an incredibly powerful tool, and I only know very little about its true potential. But it will, like every industry, AI is going to have a really big say in broking over the next decade. But there's a really strong place for individuals and for personal service. And what I find is that customers want to talk to a person and want the security of knowing that there is a person there to help them navigate what is a really important step for them in taking finance. And AI can't replace that.
So the key to being in the industry now is to have a very close relationship with customers.
It's what brokers can add on top of processing a loan application. It's the insight and the ability to advise and to educate and to, for want of a better term, hold the customer's hand through the process.
You'd have to have a close relationship with the banks as well, wouldn't you?
It really does help. Contrary to popular opinion, there's not much in the way of a vanilla home loan application. Everything has a quirk these days, and you need to be able to talk to the banks and understand how they will deal with those kinks and quirks, and whether that is an application for that lender or whether you need to look elsewhere. And we are probably putting up 20% of our loans where we are workshopping those deals and getting credit to cast an eye over them before we submit a formal application. You need to go through the banks, but you need to go through back channels. You can't get direct access to an assessor to do these things unless you submit a formal application. So if you want to get feedback from a bank, you need to go through the relationships you have at the bank to get to the right people.
Those are the back channels.
Yeah. Starting with a business development manager, and then they take it off to maybe the head of a credit team.
So the relationship with the bank starts with a business relationship manager?
Typically, yeah.
Do you see any change with that? Do you see that changing at all?
I think we've seen that has only increased in terms of the role that business development managers play in that space. So going back pre-COVID, there were one or two banks who were very good at building relationships with brokers and providing this sort of support. And the majority of banks, and probably in particular the big four banks, weren't that focused on that side of it. They were really about volume. But as the markets turned down and as they've taken notice of what some of their competitors are doing, all the banks have lifted their game in terms of their ability to build the relationship with the brokers and support the brokers in the way that the brokers need it.
Okay, and that will continue now.
I expect so, yeah. I mean, no doubt if we reach a point where volumes surge again, then there'll be a push back towards focusing on the volume to some extent. But once the patterns are established, I think they'll stay in terms of business development managers understanding how they can add value to their brokers and that, and delivering that.
And you would have close relationships with agents as well.
Real estate agents?
Yes.
Not overly. We certainly know a lot of the agents by name because we see their names come through on contracts of sale. But Hatch as a business doesn't source business via real estate agents. There are certainly broking groups out there that do that. I mean, the biggest and most obvious is probably Loan Market and their relationship with Ray White. But yeah, there are certainly mortgage brokers out there who have strong relationships with real estate agents.
But Ray White is a huge real estate firm, so you would expect them to have close relationships with larger real estate firms, like, say, the Buxtons and Jealous Craigs of this world, or the Gary Peers of this world.
Yeah, it looks, and every real estate agency has approached that in a different way. So, Gary Peer has a relationship with a mortgage broking business that they initiated, and then if I look at someone like Jealous Craig, I don't think they have a formal relationship. Not that it requires the consumer to use that broker.
Right.
The service that the agent offers, and typically there's some financial benefit back to the agent if that deal proceeds.
Well, Tim, it's been great talking to you, and thank you very much for your time.
My pleasure. Thanks.
And now let's talk to Indeed economist Callum Pickering.
Well, Callum, unemployment has edged up to 3.8%. What do you make of the latest figures?
Well, it was an interesting data release. Obviously, when you just look at the raw numbers, you might think it was a pretty disappointing release. Unemployment rate up to 3.8%, as you said, employment down by 6,600 people. But if you do take a bit of a step back and sort of look at the bigger picture, we can clearly see that the labour market remains incredibly tight, and certainly tighter than we've seen at almost any other point in sort of the past half century outside of the last year or two. So it's still a very strong labour market overall. Like I said, employment was down 6,600 people. But that follows an almost 118,000 person increase back in February. So you sort of take those 2 months together and you've got still a very strong employment growth. So it does seem as though the Australian economy continues to create a lot of jobs, which is helping contain the unemployment rate and keep it below that 4% level.
The Australian employment actually fell, didn't it, by something like 6,600 jobs?
Yeah, that's right. Now, obviously, a fall in employment is never welcome. But like I said, it needs to be understood in the context of what we have seen in recent months. That 118,000 person increase back in February was obviously very, very strong. It took basically every economist by surprise. And so we weren't necessarily expecting a very strong figure for March. The market was factoring in a single-digit employment increase. It was a little bit weaker than that, but not too much weaker than that. So when you put those months together, it's quite clear that employment growth remains pretty robust, particularly at this point in the economic cycle.
How much has employment increased over the past year?
So we're looking at employment has increased by around 337,000 people over the past year. Now, that is a very healthy number at this point in the economic cycle, particularly given how challenging the overall economy has been. It is important to recognise, though, that even with employment gains that high, and this is pretty high by historical standards, it hasn't been enough to stop the unemployment rate from inching up, which does highlight just how strong employment growth has to be on an ongoing basis to stop the unemployment rate increasing.
What was the participation rate like?
It came down a little bit in the month of March. So if we look at the underlying dynamics behind the participation rate move, we saw employment decrease. We saw an increase in unemployment. So employment was down 6,600. Unemployment was up by around 20,000. But that wasn't enough to keep up with population growth. And when that's not the case, the participation rate tends to decline. So the labour force itself was bigger than it was in February, but the overall participation rate was a little bit lower. And it has come down over the past couple of months from the historical high levels that we saw towards the end of 2023.
What's the fascinating part is whether there's been an increase in full-time employment. I believe there has been.
In the last couple of months, full-time employment has been the driving factor behind employment gains, which is a good result. But again, I think it's a result that needs to be understood in the context of what we've seen over the past 12 months. We've actually seen very little full-time employment growth over that 12-month period. It accounts for only around 25% of that 337,000 100,000 increase in overall employment. Now, just to put that number into a little bit of perspective, overall full-time employment accounts for around 70% of all jobs in Australia. So the fact that it's only accounted for 25% of the gains over the past year is obviously a pretty weak result. And it's actually sort of in contrast to what we have seen throughout the early part of the pandemic recovery. I mean, we can speculate around why that is the case. I think one of the reasons is perhaps because the unemployment rate has been so low. And as a consequence of that, maybe what is happening is that businesses are trying to attract people who haven't yet joined the workforce. And so they're providing a little bit more flexibility around achieving that. There's also been an increase in people taking on second jobs as well. So it may be more difficult to find full-time talent in the current labour market with an unemployment rate of 3.8%. But that's what the dynamics have looked like both recently and over the past 12 months.
Well, what you've always said is that full-time jobs are actually much more fulfilling and much better paid than part-time jobs.
Well, they're certainly better paid. I don't know whether they're more fulfilling. I think that's probably on an individual basis, but full-time jobs do tend to be higher quality, more secure, higher paid, obviously. And usually it's a good indication of a strong economy. So a strong economy tends to create a lot of high-paying full-time jobs. And we certainly saw that throughout the early parts of the pandemic recovery, and it's shifted a little bit over the past 12 months. So that's been an interesting dynamic that's played out. There's probably good reasons why that has been the case, and I sort of spoke about some of those, but it's certainly we're not seeing the same level of full-time job creation that we saw 12 months ago or 24 months ago, which does indicate that the economy is not creating the same quality of jobs that it was a couple of years ago.
Well, that might be because of the RBA's rate hikes. Would that be right?
Well, certainly the RBA is trying to slow the economy down, and it is, fundamentally working, although the job market does remain, highly resilient. We're seeing the impacts of tighter monetary policy across a range of economic indicators, job vacancy rate, retail spending being, key ones. Inflation obviously has come down a lot as well. So what the RBA is doing is working. But one of the negatives of that is that it can obviously have a big impact upon the jobs market. It hasn't necessarily shown up in the unemployment rate increasing by much. It's still obviously very low, but it can impact, job creation, the types of jobs being created, the quality of the jobs being created as well. But I think overall, when we look at the job market, its resilience has been one of the reasons why we've been able to absorb this cost of living crisis as well as we have. So it's probably been a good thing that unemployment has remained really low, while we have seen adjustment across other economic indicators.
It's interesting because historically, I can't remember unemployment being this low. I mean, compared to other periods of time when it's been much higher.
Well, that's right. I mean, we got to as low as 3.4% back in October 2022. And I mean, we're only slightly above that now. And that was the lowest level in around 50 years. So you're going back to the early 1970s before you've seen a tighter labour market in Australia. So it's highly unusual. And the fact that it's proven to be so resilient and the unemployment rate is still so very low is really quite a remarkable achievement. I think it's quite surprising, really, if we were thinking back to how we thought about things 12 months ago or 2 years ago. I think most economists would be a little bit surprised by just how resilient the job market has been. But like I said, it's allowed us to absorb the impact of cost of living pressures much easier than it would have been had the unemployment rate spiked to 5% or 6%. Had that been the case, I think a recession would have been a very likely scenario, but we've managed to avoid that because people still have jobs. And so they've been able to deal with those cost of living pressures.
What will this mean for the RBA? I mean, will it sway the RBA, or will they continue to keep rates on hold, do you think?
Well, they're always going to be mindful around the job market. It's obviously an incredibly important indicator of overall economic health. It is only one indicator amongst the suite of indicators that they tend to focus on. I think at the moment they're probably going to be more focused on the inflation outlook and what that's looking like, and it seems to be moving in the right direction. I think they'd mostly be happy with what they're seeing on that front. My view is that the economy overall is going to be really quite weak over the course of 2024, which is consistent with what we have seen over the past 6 to 12 months. I think that is going to be sufficient to bring inflation back to target. Whether it can stay there on a sustainable basis is another question, but I do think we'll get back to between 2 and 3% inflation at some point this year. I think the Reserve Bank could, if they wanted to, they could cut rates, once or twice, in the knowledge that even if they did that, monetary policy would still be quite a drag on the overall economy. So they wouldn't be overstimulating the economy by cutting rates now.
That said, I mean, you said it was a tight labour market before.
Yeah.
That would surely put pressure on wages.
Well, it will. So one of the things that we need to be mindful of when we think about monetary policy is that there is a little bit of a disconnect between wage growth and productivity growth. And the tight labour market is putting pressure on wages, which are currently at their highest level in around 14 years. At the same time, Australia's productivity performance is quite weak. We need to see that disconnect sort of go away, either by productivity growth improving considerably or wage growth coming down a little bit. And that needs to occur if the RBA wants to keep inflation within that 2 to 3% target on a sustainable basis. So like I said before, I think the RBA can get it back to between 2 and 3% this year, but whether it can stay there is a different question. And the RBA probably has a couple of boxes that they'd like to see ticked around service sector inflation and the productivity problem before they would be really comfortable about cutting rates. But like I said, I think they could cut rates without being too concerned about overstimulating the economy, given how weak measures of retail trade are and household spending and things of that nature.
That said, the RBA would be mainly focusing on the sustainability of all these figures.
Well, that's right. Yeah, I mean, they're always trying to take a longer term view of things. They're well aware that when you set monetary policy, its impact isn't felt for a good 12, 18 months, 24 months. So you're trying to sort of predict where things are going. And so from an inflation standpoint, it may not necessarily be enough to get back within the target, although obviously it helps. They also want to believe that it can sustainably remain there. And that's where the productivity side of things becomes really important. That's where the wage growth side of things is really important as well. The disconnect there could potentially lead to high-ish inflation over the long term. And so that would obviously be a concern for the Reserve Bank. So they want to see that, they want to see clear signs that that is improving and that things are shifting there before I think they'd be 100% comfortable in their ability to keep inflation within the target.
Which is a challenge given the volatility of the figures.
Well, that too. Obviously, the inflation figures can be highly volatile, which is why we tend to rely more upon those core measures that strip out some of that volatility. And the RBA will tend to focus on those measures a little bit more than headline inflation. But nevertheless, there is, even from year to year, there can be a high level of volatility that sort of goes above and beyond what you might expect given the, wage growth dynamics that an economy has or the productivity dynamics that a country has as well. But of course, that's why the Reserve Bank, governors and board, they earn the big money because they've got to look through these things and get a sense of what matters and what doesn't.
Well, Callum, as always, it's been a delight talking to you and thank you very much for your time.
Thanks, Leon.
What's happening in the news? Well, inflation in Australia has come in higher than expected during the March quarter, dampening expectations of interest rate cuts later in the year. The March quarterly consumer price index from the Australian Bureau of Statistics showed prices increased by 1% during the March quarter, leaving the annual inflation rate at 3.6%. Economists had expected inflation to increase by 0.8% in the March quarter and by 3.5% annually. Service inflation is the main culprit holding back progress. Insurance premiums jumped by their most in 23 years. Rents grew at their fastest annual pace since 2009, and education fees saw their largest quarterly rise in 12 years. All in all, it was a record-breaking quarter for all the wrong reasons. There are other risks. Looming stage-3 tax cuts due to start in July will keep the RBA on its toes. Those tax cuts will add money to the economy. At the same time, the RBA is trying to take it out. What's more, a chunk of progress on inflation has come from temporary government rebates that will eventually unwind. There are ongoing threats to further sufficient declines in inflation. New supply chain risks and rising oil prices from escalating tensions in the Middle East, ongoing strong demand for housing and a tight labour market will continue to concern a Reserve Bank determined to get CPI back into the target band from mid-2025. Those aren't deal breakers for the RBA, but they will delay rate cuts. The data has reduced the likelihood of Reserve Bank of Australia cutting interest rates later this year. Australia will cut the growth outlook for the most major economies, including key trading partner China, when it releases its budget next month. Treasurer Jim Chalmers warned on a fragile global outlook, citing slower growth forecasts for China, the United Kingdom and Japan in the May budget. He said, events in the Middle East are casting a shadow over the global economy, compounding the concerns about lingering inflation and weaker growth, Chalmers said in a statement on Sunday. Uncertainty about the global outlook were central to talks the Treasurer held with international counterparts and central bank chiefs in Washington in recent days, where he attended meetings of the G20 finance ministers, the IMF and World Bank, he said. Australia's Treasury Department forecast GDP for China, India, Japan, the UK and the US in their budget updates. China's economic expansion is likely to rebound 4% this year, and in 2025 and 2026, the weakest period of growth since the nation started to open its economy in the late 1970s, Chalmers said. Japan's forecast 2024 growth was lowered by a quarter of a percentage point to 0.75%, following weaker than expected consumption figures, the statement said. Japanese household spending fell 0.5% in February, sliding for a 12th consecutive month, recent data showed. Chalmers last week said Australia is on track for a second consecutive surplus when it hands down the budget in just less than 4 weeks' time. Barrenjoey Chief Economist Joe Masters said, from a budget perspective, there would be a continuation of last year's mantra of targeted and temporary support to low-income households that will spend on essentials and not discretionary items. Barrenjoey is tipping the Australian economy was now at its weakest point and would remain subdued for the next 4 to 5 months before the July tax cuts kick in to stave off a really sharp slowdown later this year. And free-to-air broadcasters are preparing for a furious lobbying effort to change proposed laws that put at risk one of their crucial sources of revenue, live sports, as new figures show young viewers have all but switched off their networks. In 2011, teenagers spent on average 75 minutes every day watching commercial television. Nowadays, broadcasters say that figure is 13 minutes, an 83% decline. For children between 5 and 12, viewership has fallen to 15 minutes from 59 minutes. The figures are included in a submission from Free TV to the government as part of its argument against restricting junk food advertising, as the networks also face the prospect of losing their dominance over the nation's major sporting events. It has been a tough year for broadcasters and media companies more broadly. New data shows the amount of advertising spent with metropolitan television stations fell 17.1% in March compared to the year before. The ad market is down 13.6% in the first 9 months of its financial year, Guideline SMI reported. Guideline SMI measures how and where the big advertising agencies spend. A 13% drop would equate to a loss of about $230 million from the market. Networks also face a limit on gambling advertising. The government wants to restrict online gambling ads, which are worth $300 million a year. They'll lose millions when deals struck with Meta under the News Bargaining Code end this year. All these regulatory hurdles come as broadcasters lose viewers to the likes of YouTube, Netflix and Prime Video. Independent research from Meltwater and We Are Social has found the average Australian TikTok user spends almost 1.5 hours on the platform every day. The dramatic decline in TV viewers under 18 does not mean total viewership of free-to-air TV has fallen by a similar amount. Commercial TV networks virtually stopped producing any children's show after a government quota was removed in 2021. They have instead been investing in more lucrative reality TV, news and sport. And major supermarkets are accused of confusing and potentially misleading consumers with promotional labels which do not always reflect genuine discounts as Australians continue to struggle with the rising cost of groceries. New research by consumer advocacy group Choice shows 1 in 4 Australians find it difficult to tell whether certain promotional price tags at major supermarkets represent a genuine discount on the usual price. A variety of price tags from Woolworths, Coles and Aldi, including While Stocks Last, Super Savers, Down, Prices Dropped and Member Price, were examined in the research, and more than 1,000 consumers across the country were surveyed. One example, which confused half of the respondents, was a coconut water produced at Woolworths. It was priced at $4, a price drop tag. However, the price has consistently been $4 for almost 5 years since being reduced from $6 in July 2019. According to the consumer watchdog, where an item is offered at a sale or a special price for an extended period of time, it may be misleading to call it a sale or special price, as the price has effectively become the new selling price. The research found that the most confusing label was While Stocks Last at Coles. Opinions were split over this soft drink product, where about a third, 31% of the respondents, said the product was discounted, roughly another third, 36%, believed it wasn't, and the remaining third, 33%, were not sure. Coles didn't confirm whether it was a discounted price, but said While Stocks Last tickets offer customers a chance to buy items which are only available at Coles for a short time, and which are unlikely to be restocked once the products are sold through. The Super Savers label at Aldi also confused shoppers, with around a third of respondents unsure if it was a discount, according to the research. Aldi did not confirm whether these cucumbers were discounted, but said the Super Savers offers across fresh produce, meat, fresh seafood and bakery provide even better value on our already low-priced products, and prices do fluctuate as they are more readily susceptible to market conditions, favourable or otherwise. And the Federal Government's E-Safety Commissioner won an emergency injunction in the federal court late Monday to force Elon Musk's X to remove videos of last week's Sydney terrorist attack after the billionaire mocked earlier takedown demands. The injunction requires X to block the video globally, but it captures only specific posts identified by the agency in its case, and new uploads of the videos, or those on other sites, would not be covered by the ruling. The E-Safety Commissioner has already threatened X with fines of as much as $782,000 for each day the video remains online, and legal experts said an injunction was a last resort that relied on US courts to be enforceable. The disturbing video of last week's Sydney church stabbing remains easily accessible on X, underlying inherent weaknesses in Australia's online content rules, even as all sides of politics have blasted the arrogance of the social media platform and its owner. Barrister Christopher Tran, representing the Commissioner, conceded during the urgent hearing that an injunction might have limited impact on blocking the video in Australia. It's probably out there on other platforms, so it might be said there's a degree of futility in granting an injunction in these circumstances, he said. In arguing for the court order, Mr Tran told Federal Court Judge Geoffrey Kennett free speech concerns were not an issue because the videos depicted actual violence, not matters of traditional speech. This is a graphic and violent video, Mr Tran said. There'll be irreparable harm if it remains online. This kind of material can be co-opted by those seeking to fan public anger. But Melbourne barrister Marcus Hoyne, appearing for X remotely, said some videos could have important free speech value, citing a previous case where an Indigenous family had wanted footage of a death of their relative released so the world could see the horror of it. Mr Hoyne stressed that the E-Safety Commissioner's orders captured the entire world, including countries where it would have no consequences for Australia. He also said that it was 2 a.m. on Sunday where his client was located, which made it impossible for him to get instructions on how the company wanted to respond. Justice Kennett appeared to agree an injunction against X might have limited impact. The horse has bolted onto other platforms, Justice Kennett said, asking whether the Commissioner would pursue those sites too. Mr Tran said that was possible, but argued that the fact that the material could be accessed elsewhere did not mean a loaded gun should still remain in the form of the post on X. Justice Kennett also raised questions about the reach of Australian law, asking if there might be arguments about the territorial reach of the Act to US entities like X. Mr Tran said there was a clear connection to the case in Australia, but the injunction is only preliminary. These issues were not fully examined. The court will instead determine where the law applies if a case goes to a final hearing. Melbourne University law professor Jeannie Patterson said even taking court action to enforce orders under the Online Safety Act might fail if foreign governments did not cooperate. How successful this would be is unclear, given that platforms have greater protection from tort and related liability in the US and arguably more stringent free speech protections, Dr Patterson said. As a last resort, the E-Safety Commissioner could apply to the Federal Court to order a social media company to stop providing that service in Australia, or for an internet service provider to stop block the service in Australia. However, the watchdog said banning a social media platform is a very serious step and would only be considered if a service poses a serious threat to the safety of Australians. The E-Safety Commission is led by Julie Inman-Grant, who Mr Musk likened to a censorship commissar. X has rebuffed Ms Inman-Grant's order for the removal of videos depicting the attack on Bishop Mari Emanuel as he conducted a church service that was live-streamed last week, saying it was akin to a global ban that goes against the very principle of free and open internet and threaten free speech everywhere. X, in a statement released on Saturday, said it believed the Commissioner's order to remove certain posts in Australia that publicly commented on the recent attack was not within the scope of Australian law. There is a public conversation happening about the event on X and across Australia, as is often the case when events of major public concern occur. The government's social media platform's government affairs account posted, While X respects the right of a country to enforce its laws within its jurisdiction, the E-Safety Commissioner does not have the authority to dictate what content X's users can see globally. A spokesman for the E-Safety Commissioner said the takedown notice only referred to videos of the attack, not the surrounding discussions about the event on X. Politicians from all sides criticised Mr Musk on Monday. Prime Minister Anthony Albanese said broadcasting of inflammatory content on social platforms risk exacerbating trauma for witnesses and survivors of violent events, calling X's actions extraordinary. A 16-year-old boy was charged with terrorism offences after he allegedly stabbed Bishop Emmanuel at Christ the Good Shepherd at Sydney's Wakeley. Police officers were injured in the subsequent riot, over which 3 men have been charged. And 10 says that Bruce Lemon should be forced to cover millions of dollars in legal fees for Network 10 and Lisa Wilkinson because he lost, and because he rejected an offer to drop his defamation case and walk away in August last year. The former Liberal staffer, who's been found by a federal court judge to have raped Brittany Higgins in a Parliament House office, lost his high-profile case against 10 and Wilkinson last week. He had sued over an episode of The Project that aired in February 2021 that interviewed Ms Higgins about her then alleged rape. Justice Michael Lee found 10 had successfully shown it was more likely Lemon raped Ms Higgins in the early hours of March 23, 2019 than not. Now the parties have filed their arguments about who pays what. The matter returns to court on May the 1st for a hearing. On August 31 last year, 10 and Wilkinson made a walk-away offer to Mr Lemon and his lawyers. They asked that the case be dismissed without any admission of liability and that each side cover their own costs. He had 14 days to consider it. The offer was rejected less than 2 hours after it was made. 10 has argued that by that date in August, Mr Lemon had 21 affidavits, outlines of evidence and expert reports. It must have been apparent to Mr Lemon, as at the date of the offer, that the chickens were coming home to roost, 10 wrote. 10 and Wilkinson's own lawyers are using this rejection to justify arguing for what is known as indemnity costs. An indemnity order is granted in exceptional circumstances and allows the successful parties to claim between 80 and 90% of legal costs. And meanwhile, Liberal MP Linda Reynolds has vowed to continue with the defamation suit against Brittany Higgins if Higgins continues to claim there was a political cover-up after the Senator's former staffer was raped in Parliament House. Higgins made her first public comments on Saturday since Justice Michael Lee found on the balance of probabilities, the civil standard of proof, that Bruce Lemon had raped her in Reynolds' ministerial office in 2019. While Higgins apologised to Reynolds for the hurt caused by the years-long saga, the former staffer said her perceptions and feelings about what happened in the days and weeks after my rape differed from those of Reynolds and a former Chief of Staff, Fiona Brown. I hope we can resolve our differences with a better understanding of each other's experience, Higgins said. Reynolds, in a written statement released on Sunday, said she appreciated Higgins' apology, but added she would continue with defamation action against her and her partner David Shiraz over statements the couple published on social media. Reynolds emphasised her legal action was never about the truth of the rape, but rather about claims Reynolds had failed to support Higgins and subjected her to a damaging political cover-up to protect the coalition from scrutiny. My action deals with what Justice Lee exposed as false allegations raised 2 years after the rape, Reynolds said. Justice Lee's finding that there was no political cover-up, which he said was the most important theme of the project story, fueled media and opposition scrutiny of a $2.4 million federal compensation payment to Higgins. The payment was arranged in December 2022 after prosecutors dropped charges against Lemon after a mistrial due to juror misconduct. And that's it for this week. And next week I'll be talking to Ben Weiss, CEO and co-founder of the platform Olive, to learn more about how Australians are using crypto, the importance of making it more accessible, the impact of crypto on local economies, tips for first-time traders, and the future of crypto in Australia as it becomes a key player in the market. And I'll be talking to economist Saul Eslake about Australia's housing crisis. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. If you like Talking Business, please leave us a review with Apple Podcasts. Thank you in advance. In the meantime, you can catch me on Facebook, Twitter, Instagram, LinkedIn and YouTube. And if you want, leave a comment. If you want to contact me, email me at leon@leongettler.com. I answer all emails. Wishing you all a safe and healthy week and looking forward to bringing you Talking Business next week.